A single policy decision made in Tokyo is setting off a chain reaction that threatens to hit pension funds and investment portfolios around the world. For the last 3 decades, Japan has kept interest rates at or below zero. They became the world's primary source of cheap capital. Now, the Bank of Japan is preparing to end that era, signaling a move to raise its policy rate to 1%, the highest level in 30 years. They are making this move because domestic inflation reached 2.8% in April, sitting well above the central bank's stated target. This chart compares Japan's historical near-zero wage growth against recent data. You can see a sudden 3.5% spike in base pay during the spring negotiations. This tells the central bank that inflation is now self-sustaining, rather than a temporary shock. The era of endlessly free Japanese money is ending, forcing the country's economy to operate on a positive interest rate for the first time in a generation. Complicating matters is the currency itself. The Japanese yen has been stuck at a weak level, trading above 160 to the US dollar. Because Japan imports its food, fuel, and raw materials, and pays for them in dollars, a weak yen imports inflation directly into the domestic economy. Tokyo spent a record $73 billion in direct market intervention to defend the currency. It barely moved the needle. With direct intervention failing, the central bank's only remaining tool to stop this imported inflation is to raise domestic interest rates. While a rate hike addresses Japan's local inflation, it also impacts a massive, invisible structural dependency resting underneath the global stock market. This dependency is built on the yen carry trade, a strategy that channels trillions in borrowed capital into the global financial system. This diagram explains the mechanics. Step 1. An investor borrows yen at a near-zero interest cost. Step 2. That borrowed yen is immediately converted into US dollars. Step 3. Those dollars are invested in higher-yielding assets like US Treasuries, the S&P 500, or Bitcoin. Step 4. The investor pockets the carry, the 300 basis point gap between the cheap loan and the investment yield. The carry trade functions as a machine that manufactures profit out of the international interest rate gap. Because this strategy offered easy profit with seemingly low risk, institutional investors utilized it on a massive scale, turning Japan into the world's primary lender. This chart of foreign holders of US debt shows the scale of that lending. Japan sits at the top, holding roughly $1.19 trillion in American government bonds. Analysts estimate core positions of this trade at around $300 billion, but once you factor in opaque derivatives and off-balance sheet exposure, the true exposure likely reaches into the trillions. This system relies on 2 conditions. Japanese rates must stay at the floor, and the yen must remain weak. A significant portion of global asset prices is now sensitive to the interest rate gap between Japan and the rest of the world, leaving little room for a change in Tokyo's policy. When the Bank of Japan raises rates, the value of the yen rallies. A stronger yen makes the original global loan immediately more expensive to repay. To cover that expanding debt, traders liquidate foreign assets. They use that cash to buy back yen, driving its price higher, expanding the debt further, and forcing another round of selling. When the carry trade reverses, the same mechanics that once generated profit now accelerate a cycle of mandatory liquidation. We saw this play out on July 31st. The Bank of Japan raised rates by just 15 basis points, triggering the crash of August 5th. The fallout in Japan was immediate. The Nikkei dropped 12.4% in a single session, its worst day since 1987. The contagion crossed borders within hours. The S&P 500 fell 3%, and the volatility fear gauge spiked from 17 to over 65. Now, the expected upcoming hike is 25 basis points, launching from a baseline where the currency is already under heavy pressure. To track invisible market risks before they break into the mainstream, sign up for the Finance Bureau newsletter using the link below. The shift in Tokyo forces an immediate repricing of global debt. When the global carry trade unwinds, the resulting sell-off spreads through markets regardless of an individual's personal exposure. In August of 2024, a 15 basis point move in a foreign interest rate erased trillions of dollars in market value in a single week. Investors watched as a sudden, violent tremor swept through global exchanges. For decades, the standard advice for surviving moments like this was the 60-40 retirement portfolio. By splitting money between stocks for growth and bonds for safety, investors believed they were protected. But when the sell-off hit, that bond cushion failed to soften the blow. This chart shows what happens when correlations collapse toward one. Historically, when equities drop, bond prices rise. Here, both legs of the portfolio sink simultaneously because institutions are forced to liquidate every asset they own to raise cash. The root cause of this collapse lies in the leverage that built the modern market. For 30 years, global finance was propped up by a massive invisible margin account fueled by virtually free, zero-interest Japanese money. The crashes of 2024 were the first tremors of that 3-decade-old financial machine being deliberately and permanently switched off. The mechanism driving this change originates in Tokyo. For a generation, Japanese investors bought foreign assets because domestic government bonds paid almost nothing. Now that logic has flipped. They can suddenly earn respectable returns safely at home without taking on the risk of fluctuating exchange rates. In May, the 10-year Japanese government bond yield touched 2.8%, the highest since 1996. By summer, the 30-year broke above 4% for the first time since 1999. This visualization shows the massive $1 trillion pile of US debt owned by Japan. If even a tenth of that moves home, it represents $120 billion of selling. We are already seeing this shift, with Japanese investors selling roughly $30 billion of US bonds in the first quarter of 2026. Moving that capital back to Japan eliminates currency risk for domestic investors. However, it creates a massive vacuum of buyers in the US financial system, which is forcing the US Treasury market to find new sources of liquidity to replace the departing Japanese capital. When the US Treasury market has fewer buyers, the mechanical result is a drop in bond prices and a violent spike in yields. Those higher yields feed directly into the everyday economy. They raise the rates on US mortgages and increase the borrowing costs for every corporation trying to fund its operations. In the stock market, rising yields increase the discount rate used to calculate what future corporate cash is worth today. As that rate climbs, the present value of those future earnings drops, compressing equity valuations across the board. This pressure lands on a US market that has been carried higher by a narrow, concentrated bet on artificial intelligence. When leverage unwinds, these momentum-driven positions are the first things sold to meet margin calls. This contagion is already active. In early June, the Nikkei fell over 3%, while South Korea's market triggered emergency trading halts following a plunge of nearly 7%. A fractional interest rate adjustment in Tokyo is the direct mathematical trigger, actively eroding the value of the average American's retirement account. If a tiny hike causes this much global destruction, why doesn't the Bank of Japan simply stop raising rates? Because they are trapped. Japan's sovereign debt sits at over 200% of its GDP. According to the International Monetary Fund, that is the highest debt burden in the developed world by any measure. Out of Japan's 122.3 trillion yen budget, debt servicing swallows a record 31.3 trillion yen. This assumed an interest rate of only 3%. Every hike piles billions onto the debt bill, pushing the bond market toward a danger line. The central bank is caught in an impossible choice. If they don't hike, the yen sinks and inflation entrenches. If they do hike, they bankrupt their own government. This is the contradiction at the heart of the crisis. The Japanese government requires cheap financing for record spending, but its own central bank is raising the price of that exact financing. This environment is far more dangerous than the market shocks of the 1990s. Global leverage structures have been rebuilt on a much higher base, while global stocks sit near all-time highs. Informed investors are actively preparing by reducing leverage and trimming crowded trades. They are treating the Bank of Japan as a global liquidity provider, whose decisions reach far beyond local borders. The era of free money is over. Surviving the coming volatility requires understanding why a diversified portfolio will fail you if you ignore the mechanics of global leverage.